G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be trying to value Netflix stock using owner's earnings. So pretty much what we're going to do is we're going to run a bear case, a base case, and a bull case on different owner's earnings models to try to determine whether Netflix stock is trading at good value and whether there is any margin of safety here. So before we get into it guys, make sure you like this video and subscribe to my channel. So obviously there's a bunch of different numbers on your screen right now. Don't get too intimidated by it because I'm going to run through each one separately so everyone understands what's going on. So let's start at the very top here. We've got our current share price of Netflix, which is $190.36. We've got our current shares outstanding, which was taken straight out of their quarterly earnings. And then the first thing we want to try to do is work out the total capex, because this is going to come into play when we calculate owner's earnings. So what I've done is I've taken the content spend or the content capex over the last 6 years, and I've taken it straight out of their earnings reports over those years. And I've also taken out capex for plant, property, and equipment, and I've added up these in total. So you can see here that in 2021, they had total capex, which includes content spend and plant, property, and equipment spend of just under $18 billion. And because we're going to be projecting out into 2026, what I've done is I've taken some averages. So I've taken the mean and the median total capex here. And for this video, we're going to use the mean capex. So what I've done is I've taken the mean capex and I've grown it out by about 10% per year. So what I'm predicting is in 2026, Netflix are going to have capex of about $19.4 billion. So we're going to be using this as we grow out our earnings into 2026. What I've also done is taken the cash from operations from 2016 to 2021 for each year, and I've taken this straight from the cash flow statements of each of these years, and I've inputted them into this table here, as you can see. So now we're going to move on to our first model. So the first model assumes 90% maintenance capex spend and 10% growth capex. So essentially, when we calculate owner's earnings, we want to count maintenance capex as capital expenditure. However, we don't want to account growth capex as capital expenditure, as we don't want to count money that's going back into Netflix's business for growth as capex. We want to count it as owner's earnings. And so pretty much what I've done is, because we've assumed growth capex is 10%, we've taken the cash from operations and then we've minused the total capex here and times it by 10% because there's 10% growth capex and we want to account for the remaining 90%, which is maintenance. And I've done that for every year here. And in 2021, we get owner's earnings assuming, the 10% growth capex of $2.1 billion. So then I've been able to grow this out over the next 5 years. And in a bear case, assuming 5% growth and using the 2026 estimated capex spend here of $19.4 billion. This gives us owner's earning assuming 5% growth of $4.6 billion, using 10% growth in our base case, $5.4 billion, and in our bull case, assuming 15% annual growth, $6.2 billion. And if we apply terminal multiples of 10, 15, and 20 respectively, we get share prices of $103, $178 and $276 for our bear, base, and bull case. And in this case, you get a CAGR of -11%, -1%, or 8% per year. However, this is our most bearish case, as we're assuming 90% of the CapEx is for maintenance to maintain subscribers on the platform, and only 10% is used to attract new users on the platform. And I think this is probably it's probably not right, but obviously it's for you guys to decide, because we've got 3 different models here. So the next model is going to be assuming 70% CapEx, maintenance CapEx, and 30% growth CapEx. So let's just move this up the screen so my face does not block you guys. So as you can see, again, we've got the bull, the bear, and the base case. And for these owners' earnings here, instead of timesing it by the 10% growth capex, we're timesing it by the 30%. So more of the essentially there's more owners' earnings now. Instead of 10%, there's going to be 30% of the capex spend coming through as owners' earnings. And if we take that same maintenance capex as before, this is going to give us a 2026 owners' earnings of 13.1 billion. In the bear case, in the base case, assuming 10% growth, 15 billion. And then in the bull case, we're looking at 17.3 billion. So this is going to give us CAGRs of 9%, 21%, and 32%. So you can kind of start to see, if you believe that there's 70% maintenance capex and 30% growth capex spend, and you agree with some of these assumptions here, you can see that even the base case here is looking quite attractive. And then for our most sort of, let's say, optimistic scenario where 50% of the capex is spent on maintenance and 50% is spent on growth, you can see that in 2026, assuming just 5% growth in Netflix's business, this gives a owner's earnings of $21.5 billion. In the base case, $24.6 billion. And then in the bull case, $28.4 billion. And you can see, let me just scroll down a bit more. You might have not seen all of that, but you can see here, we're looking at CAGRs of 20% for the bear case, 34% per year for the base case, and 46% per year for the bull case. So I think this is extremely kind of optimistic here, considering that Netflix have penetrated most of North America and a lot of Europe as well. Assuming that, I think they're spending more than 50% on maintenance capex, just keeping their subscribers on their platform. So I mean, it's really hard to tell. If this is, the most realistic case, obviously the returns here are pretty extreme. However, I tend to lean towards being conservative and looking at some of these sort of more conservative models here. Perhaps this first model, assuming 90% capex, is a bit too bearish. It really depends where, you've got to understand the business for yourself and make your own decisions here. But hopefully these models sort of help you sort of think about how you should value Netflix for yourself and where you're kind of at with, doing so. So anyway, guys, I'm starting to ramble here. So thanks for watching. Make sure you like and subscribe and have a good one.